the key message from this update, particularly when looked at in the context of previous updates, is that growth expectations seem to fall consistently. For 2016 and 2017, we are downgrading growth estimates by 0.2 percentage points across the board for advanced economies, for emerging markets, and for the world. For the advanced economies, we still expect pretty strong U.S. growth, but we're not as optimistic about a pickup in U.S. growth as we would have been in October. The U.S. is facing challenges due to the dollar strength, which is causing its manufacturing sector to shrink marginally, is having an effect on its trade balance. For those where monetary accommodation is appropriate, I think of Japan, I think of the Eurozone, it should be maintained, expanded. Where there is fiscal space, more infrastructure spending is certainly something that should be on the table. It's hard to see why, with very, very low real interest rates, infrastructure spending where it is badly needed is not a very good deal. In some countries in Europe, there are legacies of debt from the crisis that have to be dealt with still. So some marginal improvement in growth probably, but not as much as we would have expected a few months ago. For emerging markets, really a very, very sort of widespread, subdued growth. There's great diversity among emerging countries. There are some, such as Brazil, which are facing political problems, and there are others with fairly strong policy frameworks, which, while they are growing more slowly, certainly are not seeing anything that you could call a collapse or a crisis. What many countries share is that during the boom years of China's very rapid investment and construction-based growth, they borrowed these emerging markets, they invested in their commodity sectors. And now, with that commodity cycle coming to an end, there's a need to restructure their economies. There's a need to somehow repay those debts. So that's going to be a challenge which will not be resolved overnight. China is undergoing a process of rebalancing, which entails a shift from manufacturing to services, from investment to consumption, and overall, something we have long anticipated, a slower overall growth path. And this is very much consistent with what the authorities have also been aiming at. There is, however, uncertainty about the bumpiness of that ride, and we at the fund have long said that this could be a bumpy transition. The markets are very focused on what is going on because the spillovers from China to the rest of the world have been quite significant, both in terms of their demand for imports and the effects on global commodity prices. There's a lot of uncertainty out there, and I think that contributes to the volatility. We don't see a big change in the fundamentals in China compared to what we saw 6 months ago. But the markets are certainly very spooked by small events there that they find hard to interpret. As far as we can ascertain the fundamentals, some of which are political fundamentals, they seem to point to a low for long scenario for oil. Perhaps not at the current very depressed levels of below $35 a barrel, but the fundamentals all point in that direction. With Iranian oil coming online, with the resilience in the shale extraction industry in the U.S., the possibility of shale extraction elsewhere, it's hard to see oil going back to the $100 a barrel level anytime soon. This is something that is not going to go away, that oil exporters will have to find a way to adjust to. Looking throughout the world, I think there's a serious concern about deflationary pressures which go beyond what is being caused by the fall in commodity prices. I think this is reflected in the data. It's reflected in the last set of FOMC minutes from the Federal Reserve. So we have to be vigilant and not fall into a deflationary trap. I think the year coming is going to be a year of great challenges, and policymakers should be thinking about short-term resilience and the ways they can bolster it, but also about the longer-term growth prospects and what they can do there, whether it is dealing with problem debts, whether it is structural reform, which is something we're going to highlight in the April 2016 WEO. Those long-term actions, if they're credible, if they're consistent, if they make sense, will actually have positive effects in the short run by increasing confidence and increasing people's faith in the future.